If you're thinking about buying UK property, there's one decision that could make or break your investment, and that can be your mortgage. I'm Judy from Select Property. I spent 20 years helping global investors buy property in the UK. And the truth is, the people who understand the mortgage landscape always end up in stronger position. So in this video, I'll break down everything you need to know about UK mortgages in 2026 and a complete step-by-step process for securing your mortgage without mistakes. Now, before we get into rates, deposits, and the step-by-step of getting approved, there's a few misconceptions which can mislead buyers before they even begin. Many overseas investors believe they can't get a UK mortgage because they're an international investor. And equally, many domestic investors worry mortgage rates in 2026 are too high to still make financial sense. Both beliefs are outdated, incorrect, and can cost you opportunities. For internationally based investors, UK lenders do offer mortgages, but each lender has its own rules on minimum income, deposit size, country of residence, and documentation requirements. For domestic buyers, rates have stabilised and are in fact trending downward. In many cases, rates are already lower than the 2023-2024 peak, with a recent base rate dropping to 3.75% from a high of 5.25%. So the first thing to know is this: mortgages exist, they are available, and in 2026 they are far more accessible than people think. Let's look at section 1, how a UK mortgage works in 2026. People can sometimes think mortgages are only about the interest rate, when the reality is the product type, term, fees, and the LTV, the loan to value, matter just as much. So let's break it down. What is a mortgage? A mortgage is a long-term loan secured against property. The repayments are taken monthly and they're dependent on a number of factors. So firstly, let's look at your interest rate. This can be fixed or variable. A fixed rate means you sign up to an agreed interest rate for a set amount of time, normally ranging between 2 to 5 years. This is generally the most common route, as it means that whilst you won't benefit from the interest rate drops, you also won't be caught out if the rate rises. A variable rate means your interest rate can fluctuate, and there are a few different types of variable rate. Ultimately, a variable rate is more high risk, as you're open to the market changes as they rise and fall. But if you time it right, then it could be more rewarding. Mortgage rates in general are largely influenced by the Bank of England base rate, which sets the national interest rate for the whole of the UK. As the base rate rises and falls, lenders will often change their own rates to follow a similar pattern, and some even preempt these changes. Right now, the base rate is at its lowest level since 2023, making now an attractive time to enter the market. Next is your LTV. So your LTV is a loan to value ratio, essentially how much deposit you have versus how much you need to borrow. Let's say you have a 20% deposit. Your LTV is 80%, as this is the remaining capital you need to fund through a mortgage. Normally, if you have a lower LTV, you can access a wider range of mortgage products. The LTV you choose individually will directly affect the interest rate offered by the lender. Then we have the mortgage term. The mortgage term is the length of time you're going to repay the loan. Generally, a shorter term will result in higher monthly payments. Conversely, a longer-term mortgage will offer lower monthly payments as the loan is spread out further. And don't forget about the mortgage product fees and conditions, as this can make a real difference to the overall deal. Most mortgages come with product fees. Those with lower rates often come with a higher product fee, such as an additional £1,500 to take the mortgage out. You can add this to the total loan you're funding, or alternatively, you can choose to pay it outright as you take the mortgage out, although that's rarer. Fees are important to take into account, as sometimes mortgages with what seems like a much lower interest rate will have a higher product fee. Therefore, it's important to calculate what is actually better value over the total term. A good mortgage broker can usually assist this with calculating for you. So what about buy-to-let mortgages? When purchasing a property as an investment, you'll likely want to rent the property out and gain regular income through rental payments. If doing so, you'll need a buy-to-let mortgage, commonly known as a buy-to-let, if you're looking to leverage the property. You can take this mortgage out as either an interest-only mortgage or capital repayment. An interest-only mortgage has lower monthly payments that cover only the interest, requiring you to pay the full loan amount, the capital, at the end. A repayment mortgage includes both the capital and the interest in monthly payments, steadily reducing the debt until the loan is fully paid off by the term's end. For investors, the interest-only mortgage is the more common route. As for repayment mortgages, a much higher deposit is often required to allow for the rental income to cover the repayments. Because of this difference, interest only also allows investors to spread capital across, say, 2 properties rather than just one, and benefit from 2 lots of capital rental growth. So let's remember this. Don't just look at the headline rate alone. Compare your options. Look at the 2-year mortgages versus 5. Compare the product fees and see the cost actual differences between a 20-year term to a 30-year term. Make sure to test all options to find a figure that works for you. I've condensed this information into a free mortgage guide, which you can download by accessing our investor toolkit below. Once you understand mortgages, the next question is always the same from investors. How much do I need to put down? Let's talk about deposit size and LTV, your biggest leverage point. People sometimes assume that the minimum deposit is the best deposit. As mentioned earlier, putting down more capital as a deposit can unlock better rates as your LTV is lower. This is because if the LTV is less, there is reduced risk for the lender, meaning better rates are on offer. If you're looking at repayment options and the numbers are coming back tight, try to reduce the LTV by even 5% and you may see a difference. Often interest rates are heavily linked to the LTV bands, and the saving on interest can be significant over 2 to 5 years. We've built an ROI calculator which shows you your potential monthly payments depending on your interest rate and deposit to stress test your affordability. Click the link bio if you'd like to use it. Now, deposit size isn't the only factor you can explore when investing. Another major tool is your mortgage term. Now, extending the mortgage term is a standard way to bring monthly payments down safely. A longer term results in smaller monthly payments. This doesn't reduce the total interest over time, but it does do 2 things. 1, it helps you pass affordability and rental stress checks. 2, it can significantly improve your cash flow as your repayments are reduced. If your goal is to increase your cash flow, for example, through rental income, longer terms are extremely useful as you'll be left with a higher net yield at the end, but be mindful you'll likely need a higher deposit. If your goal is to accrue as little interest as possible, consider overpaying on your mortgage. This is where you can make a one-off or regular overpayment to reduce the interest on your loan. The terms for this can vary per lender, so check with your broker if you have any queries. Now let's walk through the actual process, the part most people tend to overcomplicate. There are only 3 steps and they're actually fairly simple. Step 1. Secure your property. People often think they need to complete mortgage approval before reserving the property. The reality is you don't. Just make sure to discuss with a quality broker first. With off-plan property particularly, you'll have months, sometimes even years before reservation and completion. This gives you ample time to arrange your assets, prepare documents, complete checks, and get matched with the right mortgage lender. With this avenue, my advice is to reserve your property in advance. Most high-quality developments with reputable developers sell out completely well ahead of completion, and if you hold back in securing an apartment, you could miss out on lucrative opportunities. The next step should be overseen by you or your broker, so don't worry too much as they'll guide you through the process. Step 2, your pre-application. After reserving your chosen apartment, the conveyancing checks are undertaken. This includes your ID verification, proof of income, bank statements, source of funds, and credit checks. My advice is to set aside time to prepare your documents to ensure a seamless application process. While both domestic and international investors can secure a UK mortgage, the process may be longer for international investors, so prepare your documents early. But this is something your broker can assist with if you're using one. Step 3, submit your application and receive your offer. A mistake people make is thinking they should apply to multiple lenders at the same time as a precaution, so they have backups in case an offer doesn't come through. This can hurt your profile and credit rating, so be wary of doing that. A single clean application with the right lender is better than multiple scattershot attempts. And again, working with a broker who has a wealth of experience is invaluable as they understand the nuances of each lender. Once submitted, lenders typically turn around offers quickly if documents are aligned and credit checks are approved. For property investment, trusted advisors can match you to the right lender before submitting any applications. Now, it's one thing to understand how UK mortgages work in theory. It's another thing entirely to have expert guidance when you're actually navigating the process with real money on the line. If you're interested about investing in UK property, whether you're based overseas or right here in the UK, get in touch with our team. You can reach out using the link in the description and we'll connect you with our mortgage specialists who can walk you through specific situations and show you exactly what's possible for you. If you're planning to invest this year, knowing how mortgages work is a key part of the process and it's worth doing that early. But another question is, should you be investing in property in the first place? So watch this video next where we weigh up property against stocks to show you which investment is best for you in 2026.